Good morning, everyone. Here we have Sid, who is the founder of Maple Finance, and David, who is the founder of Keyrock as well. Maybe we can start off with quick introductions about yourselves, what you guys are doing right now, and what was your lives before crypto.
You want to start?
Yeah. So I'm the CEO and co-founder of Maple. So we do institutional lending on chain. We launched about 2 years ago, and our DNA has always been like debt capital markets on chain. So my background was banking and finance. So I used to do institutional lending. This was lending to lending companies, effectively. And so what we've tried to do with Maple is have a diverse set of offerings. So we do tokenized T-bills, effectively that product we call cash management. And we just launched that back on Solana after a 12-month hiatus. And then we also do real-world asset lending. So we do a product that does loans to businesses in the real world where we effectively lend against their tax credits that are due from the government. And then more recently, we launched Maple Direct. And so this has been doing loans to funds, but over-collateralized. What we tried to do there was step in, fill the void that was kind of left by some of the CeFi companies. So we integrated with custodians, so it's a lot more transparent with all the loans being on chain and all of the assets being held in a custodian. But that's a little bit about us.
Very good. So I'm David, CISO and co-founder of Keyrock. We are an algorithmic trading company, market maker. We have multiple businesses. I think for today, what is relevant is our activity on chain. So we are a power user of DeFi. So we use all of the types of DeFi applications and have a lot of experience going through all of the risks and rewards of interacting with innovation. I'm so happy to talk about it today.
Awesome, cool. Maybe we can kick off with the first question about what were some of the biggest surprises that you saw in crypto that compared to your TradFi careers and that you think should be definitely improved in the first go?
Maybe I can just go ahead with that one, correct? So, I mean, I think one of it's already improving a lot, but one of the things that was very interesting is there was this misconception in the idea of decentralization and custody being a connected concept. So I don't know if you remember back in the day, there were a lot of companies talking about the fact that if you would have something decentralized, that would mean that it is non-custodial, correct? And that the decentralized alternative was the non-custodial, therefore was better than the centralized alternative, which was Binance and decentralized exchanges which hold custody of your assets. Now, what is very interesting is that in traditional markets, centralized institutions are non-custodial. So somehow kind of the whole narrative around that was very, very strange to begin with, as it kind of didn't fit the picture of the objective. So you had this whole narrative of we need to decentralize the world because we need to take custody away from the exchanges, right? But in reality, in traditional finance, like the New York Stock Exchange and Nasdaq don't have actually
kind of
custody, correct? It's already in a sense, correct? So it was actually very, very funny. And now that's a lot more clear, but it was one of the things that when we came in, it was very, very, very shocking to see how that was playing out in terms of the narrative in the technology.
Yeah. I think probably on the lending front, I mean, our initial DNA was we were doing under-collateralized loans to market makers and high-frequency trading firms. And coming in from a banking background, you would always have a lot of security, for example, and it was quite a conservative set of lending there. But the number of viable businesses in the crypto space was so small that everybody was kind of pushed further out the risk curve, I would say, in terms of lending to these companies. But what we've seen over time is that you now have other forms of very well-known crypto companies who have strong balance sheets who can borrow in a secured format. But that was probably the biggest shock I had coming in was I was used to this very heavy asset-backed form of lending, and in crypto lending it was largely uncollateralized, with the exception of the Bitcoin and ETH-backed loans, which again is very different to the type of lending you'd do in traditional finance. Banks don't do a ton of lending against gold, for example, or other, liquid traded financial assets. And what we've seen though is because it's a new space, you actually have to invent solutions here. So, Bitcoin and ETH-backed lending became really huge. You now use tools like on-chain monitoring to see how profitable the companies are that you're lending to, and make sure that they're going to be able to pay the loans back when you give them to them. But also, it's prompted us to now look outside of crypto and say, okay, well, let's do the type of lending we would want to see on here by bridging to traditional borrowers, whether it's fintech originators, companies that produce goods in the real world. So, one of the pools we launched this year is doing tax credit receivables. So those loans would ultimately be going to small businesses like restaurants, shops, and we take collateral in the form of money that they are due back from the government in the form of tax rebates. But those are now companies outside this kind of correlated sphere of crypto risk, and they're kind of benefiting from this form of on-chain finance.
Got it. And then when you look at the fintech companies, what is usually like the first barrier for them to actually come in and use your solutions? Like, what do you guys pitch to them? Because they're probably used to more regulated environments.
Yeah, I mean, regulated as a barrier is a bit of a misnomer, but what they're looking for is how are they getting compensated for coming in and taking the additional risk of doing things on chain in a new industry where there's reputational risk and other kinds of risks. And so how we try and pitch them at the moment is, first, let's satisfy their requirements around compliance. So KYC, knowing where the funds come from, knowing that things are properly documented. But then how do we entice them to put money into a protocol like Maple, which is fixed income and lending, is we have to offer them something differentiated. So if we're only offering the same thing as like an Ares or an Apollo or a KKR, it's not going to be super attractive to anyone beyond very novel early adopters who see an appeal in novel technology like blockchain. How we get the later adopters and the real family offices, high net worths, funds, and foundations and pensions who allocate the real capital is we have to offer them something differentiated that they can't get there. So that is where I actually find things like BTC, ETH, collateralized loans are appealing because they can't get them elsewhere. But we can also start to offer them lower fees. So I would say, if we can offer them lower, asset management fees, our general take rate is about 20% of interest. In a typical credit fund, that might have been like 30, 35%, and then more liquidity, so they can get their funds back sooner than a 3 to 5 year lockup. But they're not looking at pie in the sky ideas about the technology. They're looking at nuts and bolts. Is it cheaper? Is it more liquid? And does it deliver them a better bottom line at the end of the day?
Got it. Understood. Which would, I guess, bring me to my next question, right? Since we kind of spoke about the compliance and KYC part, that is, so I guess with regards to a more high-level overview, I was definitely keen to learn your opinions on what are like the key building blocks that you think are kind of required and are very important but not there. And are you, if there are any, are you aware of any development happening in the space for this?
Yeah, sure. I mean, maybe I'll take that one.
Yeah, go for it.
Just before I go on that, going back to what you're saying, back in the old days when there was uncollateralized lending, we received a lot of uncollateralized lending. We never defaulted on anything, just putting it out there. We treated every loan as if it was our own money, which I think for us was a shock when we realized that other people were not treating with respect the fact that somebody trusted you in that way. Unfortunately, the market has changed. I mean, unfortunately for companies like us, correct? But it is healthy, and we embrace it, and we think it's a good path moving forward. But it's also going to come with a lot of new opportunities throughout concepts like the tokenization of debt, which we're going to enable high leverage and let's say uncollateralized lending or capital acquisition in a form in the future. Yeah. So going back to your question, I mean, like the way that we look at it is that first of all, we need to have a split of what it is the blockchain technology as a settlement layer and what it is the blockchain technology as a, let's say, financial primitive layer, which is what we call DeFi and everything that is executable trading. Yeah? Mm-hmm. When you divide it in two, we actually believe that the stages of maturity of these two elements are completely different, while the settlement layer blockchain is already, in our point of view, rather mature for institutions, correct? Like we can trade OTC and then settle on on chain, correct? And that is using the technology, and we believe that today already institutions are at the point that they're comfortable with that. As a matter of fact, you see them using settlement networks like Fireblocks or Copper or institutional wallets and of the likes. And that settlement layer is using the technology, correct? Now, the problem is that when you go the next level, you say, okay, on top of having my technology replacing the settlement layer of traditional finance, now I want to replace the interaction and financial primitives that are incorporated. There we have a barrier to entry for institutions, and the barrier to entry would be, I would say, predominantly a matter of trust. Like, we are in a stage in the industry where dApps, or like financial infrastructure in DeFi, is similar to the early stage of apps when they came out into these Android phones, and they were clunky and they could break, and people therefore wouldn't trust them, correct? So what we're waiting for is somehow the Apple Store phenomenon, correct? Where you have an ecosystem that gets created that is approved for quality to the point that it's an afterthought, correct? Like in the way that you download an app today in your iPhone, and you know that the code is going to be good, it's not gonna default on you. That layer is definitely missing, and for institutional adoption to come in and touch it, they're gonna have to do that, because the reality of it is that we test a lot of these protocols, and I can tell you, like, the amount of protocols that fail on us is alarming. Like, there are a lot of them that they do. They have Oracle problems or reentrance attacks, collateral that gets defaulted, and in our case, we know how to handle that because that's our job, and we know how to manage the risk and deploy amounts that are small enough when you don't have certain information. But an institution that just wants to get a tokenized T-bill, they don't want to do that, correct? They just want to come in, trust the system, and say boom. And that's why today the tokenized T-bill, like you guys are doing, is absolutely ready for institutional adoption as an OTC with on-chain settlement. But even though companies like Ondo are doing it fully on-chain, there is that extra barrier of trust in the ecosystem network which needs to be built.
Do you think, it's an interesting point, because do you think that kind of relies on some degree of centralization? Like, as in they to get that trust, they kind of need to point and say, here's the brand that did this, and we trust in that brand? Yeah. Or can they trust in the decentralized infrastructure, blockchain and then applications being built on top of it?
I think it's going to be both.
Yeah.
You already can see today, okay, we have like companies that are doing auditing. The reality of it is that their track record is not 100% correct, so they don't manage to serve that function. But the ecosystems that are built on top of the blockchain or the layer one foundation can serve as that stamp of quality in first instance, but then you also have the tech. Statistically speaking, your application is going to fail less if the underlying technology forces you to build in a certain way. So going back to the analogy of the Apple Store, the programming language that is used for apps in Apple is a lot more restrictive than Android, correct? Which makes them maybe not have as much functionality, but they don't fail. Same here, correct? Like, and if you look at the programming languages that are used in chains like Solana, correct, with Rust, we are a Rust-based company as well. The language itself enforces a lot of checks and balances that are going to make your dApps more stable. So already just from the get-go, the probability of failure on a Rust engineer application is going to be less than on an EVM-based system, correct? And that's why you also see now the creation of EVM-compatible Rust-based chains or languages for deployment of smart contracts. So the whole technology needs to emerge to a point where, as the developer builds the dApp, it's forced by the technology to fall under certain categories so that mistakes don't happen and safety is kept, but as well there needs to be some central party that can say, okay, we check this and it is approved, correct? Like a little bit like Apple Store phenomenon. I do believe that that's going to be a key fundamental, correct? Like at the end of the day, no matter if you have AAA applications on Ethereum, correct? You have Aave and then you have Chainlink and so on, which are great. But a small startup that is creating an innovation has such a huge barrier because outside of the native people, everybody else is going to default mistrust them because they are a smart contract. And that's a big problem.
Makes sense. And in this equation, like, what do you also think about privacy? Because we've also been trying to get some of our products involved on chain, but then due to regulatory requirements. There needs to be like a nice set of like a privacy infrastructure, but so far we have not been able to see any, I guess, working privacy solution in the market so far. But would be glad to hear your thoughts on what are like some of the key developments in that area.
Yeah, I mean, privacy is an interesting one that kind of comes up as this catch-all for institutions, but we haven't actually met an institution yet who wouldn't do a transaction purely because they're worried about it being broadcast on-chain. Typically, they kind of default to other things like overall concern about a smart contract hack, or just the fact they can already do it bilaterally directly. Like in the case of lending, they just say, well, we could just lend directly to these folks instead of going through a protocol. I've seen the conversation around privacy drive a lot of investment this year in whether it's L2s that are privacy focused or wrapping tools where you wrap an asset or a token in a privacy enabled layer so that it can be, so that it can be transferred without, broadcasting that was you who was doing it. But I think for that to really take off, you probably need just more opportunities or more attractive opportunities on chain. Like we were working on a pilot program where you would have had a privacy wrapped asset that could have been loaned out between two very large institutions. So a large bank that was doing stuff on chain and a market making firm. But in the end, it just kind of stalled because the trading opportunities weren't that great. So I think you'll see adoption of privacy-enabled technology as overall trading volumes pick up. But I do think it's not something to kind of dismiss as large institutions will just get past it. Like I think it will still be important for them, and Keyrock probably faces this same thing, right?
Yeah, I mean, look, I think that when you look at privacy, it's also important to distinguish what are you talking about when you say privacy, because there are different elements of privacy. I mean, you could again almost divide these into two categories. You can have privacy of knowledge about what you do, which is kind of like on-chain privacy in the sense like you cannot just go and read my transaction and know that I bought in the past certain assets, which is a type of privacy that I also personally don't see too much demand for at this stage. And then you have privacy of execution, which is at the moment that you're doing an action, you want that action to be unknown just for the period of time while you do it, because of your fear that that information gives an advantage to somebody else to game you, give you a worse price. And if you look in traditional finance, you have all of these systems of what they call dark pools.
Dark pools.
Yeah, but the dark pool doesn't mean that you don't at the end do KYC or that you are not as a party understood in the network. It just means that you are hiding your buying intent. You see, and those are two separate things, correct? We can definitely have a chain that is fully transparent, where you can still track the wallets of who did what, because they don't mind, but they want to hide their activity at the moment, correct? This is if you want to buy $1 million of Bitcoin, most probably you're not going to care about either of the two. You're like, okay, whatever, But if let's say I want to go to the market today, I want to take a $5 million position on Maple, and the asset is not super liquid, correct?
Yeah.
So if I just go and do that, I'm afraid that as soon as people see that I'm starting to accumulate this position, they're going to react to me. And basically they're going to front run me into the trade, buy it, making my entry position more expensive. So that layer of privacy, that need of privacy, is purely financial, correct? And I think for that there would start to be demand.
Do you think the demand will pick up as the market becomes more efficient? Like because theoretically there's less alpha to kind of go around, so you need to preserve it with privacy.
Yeah, exactly. I mean, I think a lot of early stage funds, when they were doing these trades, they didn't even care about privacy because they didn't feel that it was affecting them whatsoever, correct? Because their need is not to be secretive. Their need is just to maximize profits, which is a different privacy need that the other type of privacy, which is encryption of information, where they could also be blockchains that are fully encrypted, correct? Like you can have a smart contract-based Monero model where everything is encrypted, and then the activity has a different use, But I think majority of institutions, as alpha becomes harder, are going to start wondering, is my alpha affected because somebody sees what I do? And you see that on chain already, correct? On chain, because you can take advantage of MEV. Today we are in a situation where basically, if you don't use flashbots to broadcast your trades on ETH mainnet, you would most probably be taken advantage of, which basically means acquiring privacy on the execution. And that's already the case today on chain execution. On order books, it's less noticeable, so people care less. But it will get to the point that it becomes more and more important. I guess probably not for Bitcoin and Ethereum, but again, if I want to buy $5 million of Maple token, I think I would like to announce that after I acquire the position.
Yeah.
Not as I do it.
Maybe for Bitcoin, if you're Michael Saylor buying
Exactly
a few hundred million or $1 billion.
Yeah.
Makes sense. And since we're on the topic of privacy, and since we're in Europe, can we go to the privacy regulations here, right? So for people or entrepreneurs that are building solutions that are catered to institutions that do prefer privacy, or the other way around, or in general just normal smart contracts, right? What do you think about the potential regulatory situation here in Europe? Because obviously based on the regulations, it kind of seems like blockchain itself is not possible in Europe, right? Because you have to delete the data after 7 days, I think. So would be curious to hear your thoughts on what are you seeing in terms of the developments in the parliaments of different countries for blockchain, and what should entrepreneurs basically be doing if things don't work out?
You wanna take it?
Yeah, I can start there. I mean, the things like GDPR no doubt make it harder and costlier to build products as an entrepreneur. But I think entrepreneurs should start backwards from trying to build the best product and then worry about fitting it into regulation, because ultimately regulation will not be static over a multi-decade period. And at the end of the day, there is at least some degree of competition on the regulatory front where a jurisdiction doesn't want to kind of price itself out of attracting innovators by making it impossible to work and to build in a region. So I think off the back of that, entrepreneurs should try and build first and foremost the best product that kind of serves their customers within spitting distance of regulation, and then look at how they need to kind of optimize it from there. But potentially look at offshore jurisdictions, if that's the case. Like, that is one of the advantages of building in crypto, is you have a truly global product. But I think what we've seen over the course of 2022 was that certain jurisdictions, Europe came out of the gate fairly fast with MiCA. Then Singapore and Hong Kong have followed suit. The US is still kind of lagging behind. But you have a degree of competition between regulatory regimes where they do want to at least attract innovators, or at least they say they do. And so it gives you options where you can keep the integrity of your product and just move to a jurisdiction which is kind of more favorable for you. The one thing I worry about with Europe is that they kind of jump the gun too quickly in terms of putting in place a firm set of rules that are going to ultimately make it a little bit too difficult to operate here. We kind of saw that with the UK rules around promotion of crypto. So, everyone can agree that it's a good idea that, grandmas and grandpas shouldn't be sold, scammy crypto products or have them advertised to them. But in putting in place that rule and saying you need to be registered to advertise crypto products in the UK, as a startup, we have a newsletter. Is that newsletter advertising to our clients if they're in the UK? And so we had to block UK recipients for a couple of months of just a newsletter about what's going on with us, because we're worried about that being construed as marketing crypto products without registration. And so I think every regulation has a corresponding equal and opposite effect, where it kind of dilutes something that you actually want to preserve. And so I think regulators should be really conscious of that. And to some extent, you should kind of. There's this old saying with Dwight Eisenhower, where when he was president of this college campus, they were looking at where to pave footpaths, and he said, instead of setting out where the footpaths should go, let's just look at where people walk and then pave over that, because that's ultimately going to be most useful. And I think regulators should kind of take that approach, see what people are actually doing, and then create useful rules around that kind of set some guardrails, rather than trying to be overly prescriptive in the activity that you want to see. Try and regulate for the results rather than the activity itself.
Makes sense.
From maybe just to add on that, I agree actually pretty much with the idea. From a technology point of view, I also think that it is not to underestimate the fact that blockchains can adapt to a regulatory environment very fast. like I don't actually think is a hurdle whatsoever. I think that whatever information compliance comes in or like reporting standards comes in, the ingenuity and innovation of this industry can deal with it very fast. As a matter of fact, you can already see today protocols that are built on top of Ethereum to enable these regulatory frameworks. Companies like Violet, where you would have like a on-chain KYC that then is transferable to multiple applications that would incorporate that technology, or you have now order books and on-chain matching engine systems that are already built from the ground up with the understanding of what are the requirements of the Singaporean regulator or the Hong Kong regulator that has given more clarity in terms of exchanges, and they're coming up really quick. I mean, we've already seen the prototypes of these on, let's say, regulatory ready matching engines on-chain already last month. Like they already exist from a technology point of view. It goes really fast, correct? The regulator gives clarity on what is an MTA and how should an exchange run, and people just build around it super quick. Yeah, so I'm not too worried in terms of technology being able to keep up with what's going on. But then you have the additional idea, which is that you can also build a layer 1 that is regulatory ready, so that everything that is built on top acquires those characteristics. So for example, you could have a layer 1 where the native wallet of the system has incorporated KYC on it. And then basically when you create your wallet, you have to do KYC, otherwise you cannot use the chain. That technology already exists. The problem is that nobody wants to use it.
Yeah, it also fragments the market, because if you have a different requirement between the US and Europe, then do you need necessarily a different layer 1 between the US and Europe?
You might have the layer 1 may be capable to get different like profiles and different regulatory characteristics, right? But the problem is not that the technology doesn't exist. People really don't use it. Like, you can KYC yourself on chain today, but you probably don't do it. And people don't do it just because they don't want to be KYC on chain. Like, but the technology is there. And as soon as the regulatory framework really comes in to enforce it, the technology will just flourish, but is there already.
Yeah. A lot of DeFi actually, operates largely in kind of compliance with the key legal requirements. On Maple, we KYC all the new lenders who come in. So we always know like the source of funds. And we have to do that because institutions who use the platform, if they're depositing $5 million, they want to make sure that they're in a pool with clean money. And so I think, these things don't require fully re-engineering the L1 or like a significant engineering lift. It's just using different business practices. But it's interesting because I think it does still hold back a lot of institutional adoption, because they have this misperception that KYC can't be done on a blockchain, but it can. Like, it's just how you operate your business. And also, it was a big trend last year that we saw. You kind of had this idea of permission DeFi and permissionless DeFi. And permissionless DeFi is easier to prototype products, easier to attract customers, but it tends to be more retail focused at this stage. And permission DeFi is kind of where the institutions are playing. So you saw early attempts at this, like Aave's Arc. We started launching permission pools in late 2021. And ultimately, our business has shifted entirely away from anything permissionless towards the permission pools, because the customer set that we wanted to attract is more institutional.
Got it, understood. And then would also be definitely keen to hear your experiences on dealing with, I guess, non-crypto native regulated TradFis. Like, what are they actually looking for to be participating in the ecosystem, right? That's like a pretty big question that's on everyone's mind. And you obviously have BlackRock coming on with the ETF stuff, but I guess that does not really benefit the on-chain ecosystems as much as they should. I mean, obviously the price increases, but it's not pretty much the same. But then if maybe they want to contribute on-chain to Solana, Ethereum, or whatever, like, what are they actually looking for in your interactions with them?
The large TradFi institutions, what are they looking for? I think ultimately it's kind of profit motif based. Like, if we look at when there was the most interest, it was 2021 and early 2022. Then as we progressed along 2022, the interest waned. And that's because nobody at those large institutions can, secure a promotion internally or kudos internally by launching a project that's not going to get any traction on the blockchain. It's also going to expose them to reputational risk. I think as we see this price action that's happening at the moment, it's actually quite positive for institutions to re-up these projects, unmothball them and start looking at doing things on chain. But the motivation will be, will be profit for them, and so you need to see more retail trading volume, more stablecoin market cap for them to to pursue projects like this, As somebody who will in future be competing with them, as Keyrock will be, I actually don't want to kind of hasten their return too much. Like, it's good to see interest in the space, but if we think about how will we as crypto native companies, Keyrock being on the market making and trading side, Maple on the lending and borrowing side, we actually kind of want to get as much of a head start as possible. And so we're looking at how do we get around them and go to like their clients to compete with them to attract funds, or their clients on the borrowing side to compete to offer loans to them. And I think of this as like an innovator's dilemma thing. So instead of trying to attract the extremely large incumbents who have very highly refined tastes and are extremely discriminating in what they want in a product and willing to kind of walk away from deals, we want to actually kind of find the newer incumbents who might be competing with them and secure partnerships with them. So as an example, we've spoken with a ton of very large banks, like tens or hundreds of billions of dollars in assets. And the partnership conversations are extremely difficult because they don't have any real pressing need to do something on chain other than to satisfy their board that they're doing something interesting. But they have a huge whopping downside that they want to avoid. And so where are we actually directing the conversation now? It's like community banks, because community banks since March have been in a much shakier position when it comes to funding. And so we can actually offer something that's much more appealing to them, secure funding, longer durations, and it's a much more meaningful potential part of their business, or there's much more meaningful benefit to them of completing one of these projects. And so I think you have to go with this kind of innovator's dilemma approach of seeking smaller partners who can move more nimbly, but where you can make a bigger difference to their business. I don't know if you find the same on the trading front.
Yeah, I mean, I think that the adoption, and I really like the concept that you're saying, which is we need to stop looking for when does the very large institutions enter into DeFi, but just at what rate are institutions, either native institutions or institutions overall, wanting to use this technology because it provides value to them. And that value, at the moment, has to be either yield or access to a new market where you can generate yield from. And I think, or naked yield. I think access right now is more of a value proposition, just because even though you can acquire yield in your own jurisdiction, you get access to a much bigger market that you can target through on-chain actions. Now, what is interesting for us is just the idea that, like, as different financial primitives get built on chain, they start to differentiate themselves from the primitives that are built in traditional finance. I think a lot of people in the industry are always looking at, okay, options markets in TradFi are huge, let's build option markets. Yeah. This, whatever is huge there, let's build this, correct? And I think that copycat mindset helps, but at the end of the day, if the only reason that you would use this technology is because you can connect with your wallet and the settlement is a little bit faster, but the financial primitive is the same, it's going to take very long time for those institutions to find a real reason to move, correct? But when they start moving is when the financial primitive shifts, correct? I think the first time that there was real interest on chain was with the creation of AMMs, because it's a new product, it's a new asset class, they don't have it, correct? And it's just interesting. Now, from a revenue perspective, they didn't seem to be as profitable as they would want it to be. So like interest fade out as the promise didn't deliver value as an investor as it was supposed to be. But an example that I find very interesting is, and at the moment there are few companies in the industry that are starting to develop interest rate swap markets on chain. And these interest rate swap markets are still very small, but they are going to start enabling the digital asset industry to have fixed rates instead of variable rates. Right now we are in a purely variable environment. And as you probably know, when you go and buy a house, you can ask for a fixed rate, right? You say, I want to take a mortgage, 20 years, and this is my fixed rate. And then you get to choose. You probably take the fixed one because you're not a professional trader, and you just want to have predictability in your cost. We don't have that in chain. So some protocol comes in, or multiple protocols come in that are developing these swapping technologies, swapping mechanisms, but they do it in a different way than how it's done in the FX market. All of a sudden, it's done with Oracle-based market-making systems. It's permissionless, so you can attach rates of any other product, and all of a sudden, you go to borrow an asset on Aave, and you get asked the question, do you want to borrow variable or do you want to borrow fixed? And as soon as those primitives that are differentiated start to provide real value, then as a off-chain company, I can actually look at that and say, okay, this is actually very valuable for me because I can acquire a product structure that I just don't have. And that's really where I think it's important to differentiate, which is the product needs to be a tenfold better than the existing product to acquire any traction, correct? And I think that's done through really innovative financial primitives, which for me is the main reason that majority of on-chain activity is not yet taking traction, which is that the approach of majority of foundations in the digital asset space is you want to build the Uniswap of my chain, here is money, build it, correct? But by definition, you just have a lot of copycat entrepreneurship instead of real financial primitives being built. And there are very few of those. But every time that you have a new financial primitive, you immediately see a spark of adoption. Immediately. You see people coming in and making the effort to transition and change to access that primitive. So my thesis on this is that as these primitives become better and better, as we have automated option markets, automated swaps markets that have a 10x-fold improvement compared to doing this in an FX broker, then you would see the interest really coming in because it's just better product. It comes down to it, correct? It has to be better product.
Yeah. Yeah, I tend to agree. Like, you have to kind of create something that's 10x better. And, in the lending and borrowing space, you have the syndicated loan market or the market of large loans traded between banks, which can take, 21 days, sometimes on average, to settle. And so that's kind of a boring example, but that speed is really important. But one kind of mental model to think of is, when the video camera first came out, you had people initially started by just trying to record plays, and then it was only later that the primitives of cinema and making movies actually emerged. And we're kind of, as David said, we're really in this like early stage for crypto products and on-chain primitives, where at the moment they just look like this Frankenstein version of what's in TradFi. But pretty soon, as with AMMs, we're starting to see versions that are kind of unique and not possible off-chain. And we have to make more of those to really attract attention, because that's when you're competing in a category of one instead of just being a new form of what's already very familiar to them. Understood.
Got it. And I guess just to go back to the point about the interesting point that you made about the innovator's dilemma, right? About instead of attracting more TradFi or incumbent players coming in, my opinion is that I think of crypto as a very capitalistic industry. I think even more so than non-crypto, to be honest, because every interaction of a user is a value extraction, and
in traditional finance,
and in crypto, I would say.
In crypto. Yeah.
And obviously there is value extraction there, but in crypto, even a normal day-to-day user is facing the same. And with that regards, like, it is even more capitalistic. And in that case, wouldn't it make more sense to have basically more, keep more of a capitalistic mindset and having just more capital coming in? That obviously, hopefully tries to be useful, obviously, but yeah.
Well, if the question is, do we have enough of a capitalistic mindset?
You mentioned that you wouldn't want the TradFi folks.
Do we want more competition? Well, it's like Peter Thiel says, competition is kind of for idiots. So we would be, we would be kind of foolish to want really large banks to come in and compete with us on, offering products just because they have, orders of magnitude more resources than us. So we are trying to be capitalistic in terms of avoiding competition. And so we want to kind of, at least our perspective is, how do we get to scale and establish kind of a dominant footprint in certain categories, whether it's tokenized lending on chain, like real world asset lending, tokenized T-bills or lending over collateralized to funds and trading desks or prime broker style lending. But we ultimately want to kind of stake out differentiation. That's what capitalism is you try and seek profit by differentiating yourself from your competitors such that you can preserve outsized economic returns. And ultimately, consumers will benefit longer term if there is more competition to kind of squash down pricing. But in the near term, you actually have to pay for that technology and that investment, and that needs to come from internally generating profits here. But if I look at the TradFi system, I would say the banking system's potentially, despite the fact that you have extremely large institutions like JP Morgan, it's a little bit more brittle than it probably was 20 or 30 years ago, because now you have this huge too big to fail risk where, JP Morgan's something like 20% of deposits in the US system, and so they can't ever fail. And if they did fail, no one can ever bail them out. And so if you have this kind of new paradigm and these new emergent competitors, what blockchain offers us is a level playing field in terms of technology where we're all kind of starting from scratch, having to learn how to use the blockchain and smart contracts, but it gives a chance to kind of reset the competitive field where you actually might have a lot more smaller players who are kind of even on a competitive field, and so the failure of any one or two of them doesn't make a difference to the overall financial sector. And it also leads to better competition where consumers ultimately benefit from better prices because we're all competing with each other to offer them a better service. I wouldn't say anyone would look at what's happened in traditional finance and say that banks have really been competing to offer great services to customers. The biggest catalyst for an improvement in banking services in the last 10 years was Apple launching Apple Pay. That's the only reason in the US that they now have Tap and Pay, which we had sort of 10 years earlier in Australia and other countries.
Makes sense. David, do you have any thoughts on that?
Look, I mean, I think I agree with everything in that regard. I mean, when it comes down to it, I think that if you're in this industry, you have to believe that money is not evil, correct? Like that it comes down to that. Like I think that if you're here, money is a tool, money is not evil, and then you use it to execute change, correct? Like of course it's a very capitalistic environment, but I don't think that's negative in any way. I think that the underlying idea that a money-driven model is inherently evil, it's what basically creates social inequality, because then society doesn't understand how to capture the best deal for themselves, correct? Like you need to have competition, prices to go down. I mean, lending, there is no reason why lending rates in South America are 15% for mortgages today. Like there's no fucking reason for that. And if we can change that, that actually has a lot of impact. Should we make money by doing that? Hopefully, yes. Correct. Yeah. So that's my view on that. My 2 cents on that. Yeah.
Yeah, but I think probably we're actually seeing limited markets. Like it's not as competitive as it should be because there's a ton of large institutions who are if they are not explicitly prevented from participating, feel like they're prevented from participating because banks currently can't hold crypto on their balance sheet because of capital restrictions. A lot of trading firms who are regulated by the SEC feel like if they start trading crypto, they're going to get a Wells notice. And so you're actually seeing distorted markets driven by the regulators. The regulator is creating market distortions that lead to worse pricing and a less competitive dynamic. And ultimately, I think it's probably not, to your earlier question, Shavin, it's probably not competitive enough or capitalistic enough because of that distortion.
Got it. Understood. Cool. And I guess since we kind of covered a lot of the questions about what people should be looking for in on-chain or overall crypto side, it would be also great to dive down more on the importance of different infrastructures in crypto and what are the key mental frameworks that you guys keep in mind to basically assess them.
What do you mean?
So infrastructure could be anything around layer ones, key pillars like layer ones, wallets, custody. What do you guys actually? What are the key points that you guys have in mind, or what's the mental heuristics around assessing them before you guys actually get to use them? And similarly, if you guys spoke to different institutions, like non-crypto native entities, what what are the thoughts that you heard from them?
We're still at the stage where majority of service providers of infrastructure have to be approached as a partnership. We're still at that stage. We're not stage where you can just go and say, this is this technology, this is the service fee, you want to get it. It needs to be a relationship where most probably the technology is immature in a sense, and you need to accept that, and therefore the only way to make it work is for both parties to understand that there is value to be paid for service, but also there is value on the adoption of the technology and helping that company to iterate. Typically what we find is that as long as we're working with a custodian or a exchange that understand that, the relationships go really well. Right? What do I mean with that is rather simple. I mean, like if you're building custody technology, the probability that your service out of the box fits my needs are probably very low. So the reality of it is that you would have a portion of customers as a custody company, for example, that will be able to use your service out of the box, but they will be not your primary customer because the amounts that they're going to be custodying are very small. Your major customers would have very unique needs at this stage, just because there are so many chains, so many like integrations, DeFi use, wallets, whatever it is. And as long as they are okay with aligning a product development roadmap with the needs of their major customers, they can then co-develop the business. And like we've done that multiple times with a lot of the infrastructure companies in crypto from back in the day. I mean, like we were using Copper already like 3.5 years ago. When they started, they had to like adapt to what exchanges we were using, how do they prioritize that into the development roadmap to try to make it a success. So my view on this is it has to be a partnership. Yeah. Got it.
Yeah. It does tend to be like an enterprise sale where you're selling them something and they're selling you something.
Yeah.
But what we look for more broadly in infrastructure is wallet support. So I think that was a big decision. When we moved to Solana, we had to look at all the wallets that were supported. I think Fireblocks just coincided, which was really helpful. Stablecoins are probably one of the biggest pieces of most important infrastructure. It's kind of you're kind of a fish in the ocean, and the stablecoins represent the volume of water that you can swim in. We can't do a ton of lending unless there's a ton of stablecoins on a given chain. And so I think that's one of the chicken and egg problems a lot of L2s today are facing, is they lack that piece of infrastructure, a canonical stablecoin that people can use there. But that infrastructure, so wallets, stablecoins, on-ramps are probably the three most important things I see for institutions, choosing whether to work with firms like us.
Understood.
Today.
And then with regards to, I guess, the broad layer one side, do you think there is like much emphasis from different entities that you guys are potentially working with? Like they actually care about it? Or like what are the key features that they actually care about from the L1 side?
I think they're broadly indifferent. I think it comes down to the big buckets. So it's like you've got a jar and you've got large pebbles, medium pebbles, and small pebbles. The really big ones are just throughput, cost, and is there a business transacting on the chain? So overall liquidity, stablecoin volume, TVL, and those are probably the major things they look at. But then when you get underneath that and unpack what are some of the opportunities for them, I think they look at differentiation. One of the things I was really encouraged by coming here this week is things like the vending machines out there that you can pay with SPL USDC with, and then DePIN, so decentralized physical infrastructure networks. And I put my lending and banking hat on and say, well, maybe not now, but 3 or 5 years from now, could you see bond issuances or debt issuance that is used to finance the growth of DePIN networks, whether it's wireless infrastructure like Helium, or could it be used for merchant facilities? So maybe you own a fleet of 1,000 of those vending machines and you have pretty good cash flow of $10 million a month. Could you borrow against that? Plenty of banks and credit funds already do transactions like that in traditional finance, and this is just, we're in kind of the first innings of seeing whether things like that will turn into viable businesses over the next few years. But I don't see any reason why it wouldn't. Like if you just look at the profit motive of somebody who's running a cafe, why do they want to keep paying 3% to Visa and MasterCard when they can pay much, much less? And those businesses don't have huge profit margins to begin with. So something like payment processing on chain where you save 3%, it's pretty meaningful to their profit margins. And so I think, if I'm a big convenience store or retailer, why wouldn't I look at using a network like Solana to kind of expand my business and then cut out costs that way? So that's, that comes down to kind of cost, but also, level of activity on the chain. Level of activity is probably the single biggest one.
Got it. Understood.
So we are a power user of on-chain applications, correct? Or we see ourselves as a power user on chain applications. When it comes down to it, there is a minimum requirement for technology to be good, but above that minimum requirement, what really matters is the community around it. When it comes down to it, like in our view, why do we use Solana, and why do we use some of the L2s on Ethereum? Is mainly where is there real innovation? Like, it's hard to pinpoint what makes it happen, but at the point that an ecosystem gets to the level where real entrepreneurs that are building or want to build crazy things that might fail or might work, choose to work in that technology, that's where it becomes interesting for us. Like, in our point of view, at this stage in the industry, there are very few places where that's the case. Majority of other ecosystems are in a catch-up mode, and their technology might be better, but that's not enough reason for you to adopt that technology, because ultimately you want opportunity, and you want to have learning, and you want to engage with real new financial primitives and new innovation. The way that I look at it today, we've been using Solana for quite a while, and we saw the Solana ecosystem as one of the only alternative ecosystems that went from catching up to what was built on Ethereum to have real differentiated applications that don't exist in Ethereum, and bringing new ways of thinking that were not possible before. And that's where it caught our attention. It became very interesting, right? So we were following it already from the beginning. As soon as we started to see differentiated innovation, we jumped in, started to experiment. And of course, we also still experiment today in ecosystems like Arbitrum, yeah? For the same reason. And as a matter of fact, we have a lot more activity on something like Arbitrum than on ETH mainnet nowadays. Just because wherever the innovators go to is where you will be able to abstract the most learning and the most long-term value, at least as an ecosystem company that is interested in understanding where this whole thing is going. If we're talking about just a user that wants to reduce cost, they're going to be looking at the technical specifications of the chain, cost of gas, and so on. But I do think that that's secondary. As a matter of fact, most probably we're going to get to a point in a few years where majority of the scalability solutions on chain are going to start to be commoditized, where all of the chains that survive will be able to implement CK technology. All of the chains that survive will be able to implement modularity, and at some point, what really will be the differentiation is the community, correct? Today, technology plays a big aspect of building that community, but in the future, it will be the community that is really there, correct? Like, when it comes down to it, majority of network tech companies work that way. Like, they might not have the best technology, but as long as they have a network effective community, innovation will keep on driving in and continue to grow. So today, we're very active in Solana because of that. I mean, of course, it's nice that it's fast and it works well.
Yeah.
Awesome.
Yeah. But I think, that specialization is really important to note. Any L1 or L2 today should be trying to differentiate itself.
100%.
Not just compete on tech specs.
Yeah, would be definitely keen to hear your thoughts on your thesis for Solana, right? What is the make or break point for you guys in terms of the technology or the ecosystem in general? Like, would be definitely great to learn from Sid about the lending aspects of it, and then would love to learn more about the trading aspect of it because of the Fire Dancer. Like, would be great to hear your thoughts on Fire Dance and like what it means for trading as well.
Okay. So, I mean, our thesis for Solana is rather simple. We think that starting from the builders, the capacity to build robust smart contracts on Solana is easier than in EVM chains at the moment. That might change, but at the moment, applications built on Solana are from a developer point of view, more enjoyable to build, easier to build, and result to be more robust and secure, which attracts those innovators, which builds financial infrastructure that is differentiated, which allow us to then capture a new market, correct? So it comes down from that, like how do you get the builders building? And so far, we are a Rust-based company ourselves. We've been developing in Rust for the past 5 years, and we're very early in that community. We basically implemented Rust technology, one of the first crypto companies to do it, and we have an engineering team of more than 80 full-time Rust engineers. So when Solana started to get adoption and we could start building smart contracts in Rust, for us it was very appealing, correct? So our thesis is really that capacity to attract builders, which I find very interesting. Other chains are going in that direction. So every chain that is building in that wave of how do you attract these differentiated founders is where we think majority of the accrued value will start for the next cycle.
And also would be great to hear your thoughts on finance and like what it kind of actually enables for those of us that don't really understand the benefits of it for the trading activities.
I mean, I think that, again, I'm going to stick to my last answer, which is I don't think that technology would be the ultimate differentiator. I think that something like FireDancer would be great for the ecosystem because new primitives will be able to be built. Yeah. But already today, Solana is faster than the other chains, correct? So it doesn't seem to me that is the bottleneck today. It's going to be great, yeah. But block times are still going to be very fast, as they are today, for 100 milliseconds. And it might accelerate adoption for even bigger applications that are looking where to deploy, so that's really great. But I don't think it's a blocker today. I don't think we're in a situation where we are hitting a bottleneck and that's why there is not enough innovation in Solana. I don't think it's the case. I think actually, if any, the opposite. The innovation is great, it's going in the right direction, and this is just going to be a tool that is going to supercharge the ecosystem.
Got it. We'd love to hear your thoughts as well, Sid.
Yeah, I think it comes down to kind of three things. So I alluded to them in the last answer a little bit, but differentiated opportunities. So when we launched back on Solana about 6 weeks ago, so we first launched over 12 months ago, about 18 months ago, but we got back 6 weeks ago and we did cash management. So just a simple place if you're a protocol treasury to park your stable coins. And we've seen about 17 mil flow in there, and we're just passing through yield from T-bills. But that's not very, that's kind of differentiated in terms of what's available on Solana at the moment. But as we look at the thesis of how do we expand our presence, we're looking at what Solana does uniquely. So I mentioned DeepIn, the decentralized infrastructure. So if you're running a wireless network or a mobile network like Helium, that could be something that we finance in future. So it's unique. It's potentially a large addressable market. It could be it's very compatible with debt finance because that's a huge area of traditional finance. And so that's one bucket of opportunities. The other is e-commerce and merchant finance and payment processing. So, Visa and MasterCard they're very focused on this because they probably stand to lose the most if everybody starts transacting in stablecoins on a blockchain. And so that addressable market is huge. There's large incumbents who could be disrupted by it. There's a lot of new, smaller competitors, and we could potentially finance them in future. And and there's a clear mechanism where it's lower cost, so it'll attract users over time, and so that will power adoption. And it's something that's kind of, to use that meme, it's like one of those only possible on Solana product use cases. That's the second opportunity. And then we touched on FireDancer before, but if you can get to an order or 2 orders of magnitude more transactions per second, which is what they're kind of touting at the moment, then we could get back to doing what we were previously doing in terms of lending to HFTs and market makers, because a lot of that activity could transition from centralized exchanges to occurring on-chain and in DeFi. And so that's a third bucket where, again, really large potential addressable market, something where we have an opportunity to be an early mover and kind of plant a flag there, and which has already synergies with debt finance because we were already doing it 2 years ago. And so those three opportunities, so DeepIn, payment processing and e-commerce, and unlocking high-frequency traders through FireDancer are 3 pretty unique things that, as I look across the landscape, are only really possible here, and that's part of our thesis.
Awesome. Thank you so much. So I guess in the interest of time, it would be great to hear some closing thoughts from both of you on what people attending Breakpoint should be focused on, and if they are catering to any more regulated plays, which I think you will be very, very familiar with, and in terms of like catering to more trading firms, because there are a lot of hackers here that are building different DeFi applications. Would be just great to have like some closing thoughts from both of y'all.
So the question is, what should people be focusing on in the Solana ecosystem?
In general, like closing thoughts on like what people here are like. I saw like a lot of people building different DeFi applications, which are, I guess, would be more relatable to you.
So I mean, on my side, very, very short, I think Solana is back. And I would encourage anybody to build on composability primitives on the chain. I think there is a lot of value to be unlocked there for the ecosystem, where there is not yet enough synergies between the different applications in the ecosystem, and whoever can unlock that is going to capture a lot of value.
Yeah, I agree Solana's back, but what I'm paying attention to is who's building new DeFi protocols. You know, I've met a lot of the DeFi 1.0 builders on Solana, and you know, those teams have been really resilient through this kind of downturn. Now I'm looking at who else is building DeFi stuff here.
Good.
Cool. Awesome.
Thanks very much.
Thank you so much.
Thank you.
Thanks, Sean.
Cheers, man. Thank you.